All right. Well, so today I'm going to be talking to you about a sneaky little tax that most people aren't aware of. And this tax applies to business owners and other high net worth individuals. But today we're going to be talking about how it applies to business owners when they sell their business, because that is where it catches a lot of people by surprise. So AMT is what I'm talking about. And AMT is alternative minimum tax. And so the way that AMT works is it's a side calculation. So you've got two tax calculations going on. You've got your regular tax calculation the tax that you must pay throughout the year. And then you've got the AMT calculation kind of going parallel with it. And that AMT is the minimum amount of tax that you must pay if you have, for example, large interest expenses or if you have big deductions. For example, if you were to use the lifetime capital gains exemption when you sell the shares of your business. So it is really important to make sure that you understand AMT because it is recoverable. When you pay AMT, you can recover it over the 7-year period following the sale of your business, for example, as long as you have qualified income. So let's dig into this a little bit more. And I'm going to apologize because it does get to be quite complex, but I'm going to try and simplify it. So down the road, you sell your business, you end up getting the first $1,250,000 tax-free. That'll save you about $300,000 in tax. So obviously you're going to be quite happy about that, but you're going to be surprised likely to learn that now you have the AMT calculation coming to play. So that is where you've got your regular tax. Now it's going to be reduced because you use the large deduction for the capital gains, right? And where you could get the $1.25 million share sale tax-free. But your AMT calculation hasn't been reduced by that much. So your AMT is actually higher than the regular tax that you would pay. So that difference becomes the amount that you owe to CRA in April of the following year of the sale of your business. So now let's just say that that's $70,000. Well, you would owe that $70,000 immediately, but you could recover it over the next 7 years. And how you're going to recover it is when your regular tax amount, the amount that you would normally pay for the regular calculation, is higher than the AMT amount. So that's where it's going to be really important to make sure that you have fully taxable income down the road when you retire. That's where RSPs could come into play. So I don't think that RSPs are all bad. In fact, they can be quite a good tool for this, because if you can draw out of your RSP investment account, or you have other fully taxable income such as employment income, that will help you to recapture some of that AMT. So let me give you an example of that. So let's say that your AMT, like we said, is $70,000. The following year of the sale of your business, you end up being fully retired, let's say, and you end up having to draw some income out of your RSP. So you've got good fully taxable income, because RSPs, when you draw them out, are fully taxable, right? And let's say your taxable income is going to be here, for example, and then your AMT calculation won't be as high if you don't have big interest expenses, or if you don't have other capital gains, for example. So if your AMT is lower, then that difference you're going to be able to reclaim. Right. So it's important to make sure that you're aware of that, because if you don't reclaim it, it becomes a permanent tax. So I do understand that this is complicated. My point to this is just to make sure that you're aware of it. Talk with your accountant about it. Talk with your professional financial planning team. Hopefully they're making you aware, because it is important. Down the road, when you sell your business, you're going to want to do income stream planning that's going to allow you to recapture it. Now, dividends, eligible and ineligible dividends, they will help you reclaim some of that AMT that's payable, but not to the same extent as fully taxable income. And capital gains will actually put you a little bit behind the 8 ball on reclaiming that. So I hope that you found this very helpful and valuable. Thanks. Take care.